Well, welcome to a market update from Principal Wealth Partners. I'm Julina Ogilvie. I am back again with Bob Paolucci, our founder and CEO. Bob, welcome.
Thanks, Julina. This is our 9th video of the year.
I was going to say it, but I'm glad you did. It's our 9th video, and maybe to put this one into perspective, the last video that we did was in September, the day after the Fed raised interest rates by 0.75% or 75 basis points, which was expected. However, the markets did not like the language. Candidly, we didn't like the language. So we had a discussion around the challenge that the Fed has about bringing interest rates down to their target level while orchestrating what the industry likes to say a soft landing. Is that correct?
That is a fact.
Yes. Okay. So now we are back because the Fed met again in November this week. They again raised interest rates by 0.75%, as expected. We've now seen 6 rate hikes this year. The first one started earlier in the year at 0.25%. Then they raised it 0.5%, and now we have seen 4 interest rate hikes at 0.75%. If you do the math, that brings us to 3 3/4 for the year. So, do you think they're done?
Interest rate increases of greater than 0.5% are considered emergency increases. There's what the Fed believes great rationale for increasing by greater than 0.5%. Again, their rationale is primarily inflation. Real estate values have gotten out of control. Youth euphoria around investing as if it's gambling in speculative investments like cryptocurrency, unicorn type investments, futuristic themes. They've seen this before. We've seen this as investors before. It has a very 1999 like just buy anything. There's a lot of money hanging around. The cost of money is cheap. You mix that with inflation, the pandemic, a lot of stuff, energy policy, so on and so forth. It creates a recipe for the Fed to really decide to do something about it, and they are. To recap, why we didn't like the Fed statement, the Fed language, and certainly the press conference from last month, in essence, go back to September, a little over a month ago, was because of some of the things that they said. Number one, there was no acknowledgement of the forecasting forward of now lower inflation numbers, right, month over month, quarter over quarter, which they've come down significantly, right? The 12-month inflation number that is quoted by everyone simply will not change quickly because the data from 11, 12 months ago, 10 months ago, 9 months ago is still in the calculation. So once that starts to roll off, you're going to see how rapidly inflation comes down, because the new numbers that are coming on are not as high as they were. And generally speaking, if you look quarter over quarter, they are lower, significantly lower. So, our argument was, how can you look at that stale data and base your actions on stale data?
It's a bit backward looking.
It's only backward looking, right? Not taking into consideration the lower inflation numbers that we have, especially relative to this time last year, right?
Right.
From a month over month basis. One. Number two, they didn't acknowledge how the data lags, whether that is housing, employment, inflation, so on and so forth. So not really acknowledging that, over the coming months and quarters, a lot of the employment stuff, the housing stuff, housing data, a lot of the economic data that is stale by nature of its reporting, there's a lagging effect, right? So this is like economics 101. So we were pretty upset that they didn't even acknowledge that data. Well, apparently everyone else was upset, so upset that in this meeting yesterday, we are now talking one day after the Fed meeting. It is November 3rd. The meeting was yesterday around 2 p.m. in their statement, they actually addressed it, which had a very self-aware, dovish, we're almost done tone to it, thankfully. They also acknowledge that they are way into restrictive territory. They know this, but they think the economy, because of the amount of money that has been infused into it, the amount of money that individuals have, the amount of money that businesses have, can withstand a little slowdown.
Right.
That is trying to bring us close to a recession, but not put us in one. And they even say if we do put the economy into a recession, it's not your typical recession. And we are the people, the group that can pull us out of it almost immediately. Exactly. By reversing course on their rate path, right?
Yeah.
And that is actually something he said yesterday, that they are willing to use their tools like they've done in the past. They're being incredibly selective with the language because they're trying not to trigger, they're trying to avoid triggering the quantitative keyword search programs. They don't want the market to just rally based on keywords, and they know the keywords that everyone wants to hear. We're pivoting, we're almost done, we're winding down, we're slowing, we might cut. So even when they talk about bringing rates down, they're not even saying cut. They're saying using our tools like we have in the past if we need to reaccelerate the economy. It was such a tactical statement, paragraph or two that was used. They really are trying to just be that parent for a little while longer before they give in to the market. And they are. If you read between the lines and if you look at their own estimates, the Fed is forecasting very likely lower increases, right? So maybe getting out of the 75 basis point increase because they're well into restrictive territory.
Correct.
And increasing by maybe a half a percentage point and then a quarter and done. But they are hedging their bets by saying we are going to rely on the data.
Correct.
Right?
Yeah.
So it's a
and so most of the market is expecting one more move in December. The question is it 75? Is it 50? Correct?
The market is 100% pricing in a move in December. And it is 50% pricing in the odds are 50% that they price in a move in February, right? Which would be the meeting after, right? So December, skip January, go to February, that would be the meeting after. There's a great pause there.
Correct.
And I'm confident that the data will dictate what they do, if anything, in 2023.
Okay.
So yes, the market is pricing in maybe 0.75 of a point more in total moves.
Whether it's December or February remains to be seen.
And is it 50 and 25? Is it 20, 25, 25 done?
Yeah.
So the way to think about this is the Fed for this market and the economy is the puppet master. It is literally holding the strings, right? It is clearly in control.
Yeah.
You could say, well, it's Russia, Ukraine, it's this supply chain, it's the pandemic. Yeah, all that stuff has contributed. But at this point, we're well beyond all that stuff. What is controlling the market and the high frequency trading institutions, the shorting of the market is really the Fed, its language, and its actual actions. And think about it this way. The Fed, if you stretch out a rubber band, the Fed is holding down that rubber band for as long as they possibly can, because when they're done, they let the rubber band go and it springs back up quite a bit very quickly. And they know this. Exactly. They know this. This is why they're being very tactical with their statements. They're hedging in the same sentence. They're hedging in the same paragraph. They don't want to blink.
Correct. And we should make note that when they when they had the meeting in September, that the markets did not like the language.
The markets went down to their lows for the year.
Correct.
In September, which was slightly lower than the prior low for the year, right? So generally speaking, we've been in this trading range.
Exactly.
That, again, the Fed is holding us in. Literally, they're holding us there. And they're controlling this environment. So generally speaking, when the Fed blinks, when the Fed changes their language and they say they're done, there is so much pent up upward movement in the market that will happen very quickly. I hate to say this, but it really is a manipulated market. So I guess if there is someone who can do such a thing and for it to be, I guess, tolerable, I guess it's the Fed, right? So they know that once they blink and once they stop, the rubber band snaps back quite a bit very, very quickly. And to give some color to the listeners, that is because all these institutions are so short the market, over a short period of time. They're using futures contracts, 1 month out, 2 month out, 3 month out, weeks out. They're using options contracts where they're buying puts, right? And all that stuff needs to either be covered or it just expires. And once all that negative pressure, which is contributing to holding us in this zone of the market, goes away,
springboard,
it reverses course. It actually goes this way. So we're almost there, everybody. This one is clearly just being held back by the Fed. And that is, according to their statement, which we're going to put up on the screen, slowly coming to an end, if we believe what the Fed is now saying. So if you could pull it up. What's very interesting is, the Fed is aware that there's a midterm election next week, right? So even if they wanted to be dovish with their statement or hawkish, they couldn't be. They want to have no influence on next week's midterm election. They don't want the blame. They don't want finger pointing. They don't want politicians talking about them. So they literally, this is comical. They took the September statement and the only thing they changed was some of their grammar, the date, what the new interest rate is, and a sentence. And the sentence that they changed is in red. So you could see that
doesn't look like a lot.
80% of the September statement made its way into the November statement. So the change was, yes, we moved rates up by 0.75% to the new rate. They say the lag effect of the data. They're also going to take into consideration, you can read it for yourself, what they've already done, right? Which is why we led with they've increased rates by 3.75% already, which is a lot in a record amount of time.
Absolutely.
So they've made up for, in my opinion, their lack of awareness in the prior meeting. So I am personally much happier that they acknowledge that, yes, we know the data lags. We know we've done a lot, potentially too much, too fast. And we're focusing on that as part of the equation going forward. Great. Now, that, if you read this statement, was very, in my opinion, dovish, right? So this is the voting members typing up an approved piece, and by typing it up, they just plagiarized the September piece and redlined a few items. But then there's the press conference, right, where Jerome Powell goes out in front of the media and he addresses, random questions by whoever he picks to ask the questions.
Correct.
And that was a circus because you had some very interesting questions. One, I think, was set up in a way where, someone talked about, hey, the market is rallying based on your comments. But, the interesting point was the market was not rallying based on the comments. So there's a chance that he thought maybe the printed statement was too dovish. So he came over the top with his response, which sounded very hawkish. I can't believe I'm talking about this stuff, but this really matters. It just tells you that this market is so hyper-focused on every word, even the grammar that the Fed is using. And we shouldn't be talking about this stuff.
Well, and I think it also brings the point that what we as the industry are talking about, no one will argue that they have more control than anything else right now.
Absolutely.
But the question is how successful they're going to be with it, right? That's the question that everyone's asking.
Yeah, but you also have to understand, and the market is, of course, not going to price in the other side. I believe I heard 5 or 6 times in the press conference, Jerome Powell saying, hey, just a reminder, we're trying to get inflation down to about 2% or so where it was. We think we'll be able to do that. And keep in mind, if we over tighten, we can quickly reverse course and use the tools that we've used in the past. So in English, that means, hey, everybody, just like we increased rates, we can cut them very quickly. Exactly. Right. And if you look at our forecast for where interest rates are going to go, which is called the dot plot. They put that out every quarter. The last quarter they put it out was in September. If you just look at the dot plot, it shows us increasing rates by a little bit more, flatlining, and then coming down. And then coming down to something called the neutral rate. What's the neutral rate? The rate is actually, the temperature where it's not too warm, it's not too cold. They view that as the neutral interest rate. That rate, just so everybody knows, is 2.5%, which happens to be 1.25% approximately below where we are. So they could cut rates to that level very quickly. I would tell you that would create very likely a decade-long bull market immediately, right? The market would rally on that immediately, which is, and they know that, which is why they want to slowly get there. Yeah. Also keep in mind, in a weird way, how they explain it is they're hinting at, if we realize, because of the lag in data, that we have over tightened, we will cut sooner. Correct. So a lot of this gets lost in translation. I enjoy it because I love the nuance. I mean, we've paid attention to it for, almost 2 decades. We hear this stuff. So to me, that was the message. The press conference was very hawkish. The printed statement was very dovish. So I would say that's a net neutral. I wasn't surprised with anything that was really said in that meeting. They've already drawn the line in the sand of where they think they'll go with interest rates. So if we believe that, then they're almost done. Right. So yeah, the market's reacting a little bit to it. Yeah. But we are still well off of the lows that were set about 3 weeks ago. Okay. And we talked about the equity lows, but certainly any investor that's balanced has also seen the volatility on the bond side. There's a silver lining to that. So can we talk a little bit about that? Yeah. And this is actually a chart that we worked on, and we used data from the Federal Reserve themselves. Okay. And we just exported it into our chart here. So, if you've been talking to us, hopefully you've been listening to us talk about an increase in yields, right? Bond yields, interest rates, dividend yields on stocks, so on and so forth. And before I start to talk about percentages where nobody on this call or Zoom meeting would believe me, I had to put the chart up to prove it. So the silver lining is, if you owned a short-term bond fund last year, it was yielding approximately 0.5%, right? Now it yields about 4.5%. Now, if you at home pull up the yield on one of these bond funds, what you may not know is they quote 12-month yield, just like inflation is calculated. They take the monthly yield, correct, for the prior 12 months, they average it out with the new month, and they quote the yield looking backwards. Yep. This is a great time to stop doing that. You have to take the yield today because things have changed so fast, and you project out forward. That's the accurate way to do it.
Correct.
So yields about a year ago or so, and you can see on this chart, on 1/3 of 2022, the 1-year yield, and we're just using government bonds. If we use corporate bonds, the change is significantly higher. So we're in essence being very conservative with this. And this is right from the US Department of Treasury. So on 1/3 of 2022, the 1-year Treasury bond was 0.4%. Now it is 4.76%.
Yeah.
That is a 1,090% change in yield. Now, to get that yield, if you owned a bond, right, you had to deal with anywhere from, depending on how long the maturities were, anywhere from a 7 to 30% decrease in price to get anywhere from a 106 to 7,000% increase in yield.
Right.
So in the grand scheme of things, what investors lost in bond value is going to be made up to them in yield. You really just take hey, if you lost 10% in a bond fund that was yielding less than 1, it's now yielding close to 5. So in 24 months, you'll get paid back the decline that you experienced in price. Does that make sense?
Absolutely.
Right.
And it sounds like the acronym TINA is dead, that has been around for so long, which was there is no alternative.
Yes.
And we can finally look at the bond market for yield again, which has been a struggle for retirees.
Yeah. And what is the new one? TARA. There are real alternatives.
Yes.
Yeah. So out with TINA, in with
new
TARA.
ones.
Yeah, in with TARA. And you can see here that yields as of 1/3/2022, assuming you can squint and see this, I can barely see it, but that's yield across the 1 month, 2 month, 3 month, 6 month, 1 year, 2 year, 5 year, 10 year, 20 year, 30 year bond rate to start the year, and where it is as of last night. Yields are exponentially higher in most cases. So all you have to do to get your money back, to recoup any money you lost in bonds, is just hold them and wait a year, in some cases 2, in some cases 3. That's it.
And if the Fed actually cuts rates going forward, you may actually see some appreciation back as well.
Yeah, that might confuse people, but you're absolutely right, because now you own a almost 5% bond in an environment where the Fed cuts rates. Your 5% bond looks much better in a 3% world. Not only will you keep getting that income, you will get appreciation in that investment as well. So that is why we think the end of the hiking cycle creates a very long bull market in bonds. So the first bull market that is going to start, may have already started, is in the bond market. The second, which will happen very quickly thereafter, is going to be the stock market. If you go back to the Fed's statement in September, the only thing that I did like there was, hey, just remember, when we start cutting rates and we have low inflation, we're going to create, like we had before, an 8 to 10 year extended bull market. That was lost in the shuffle, because everything else was ridiculous that was said at the prior meeting. But he's absolutely right. A low rate environment with low inflation is a risk-on environment. So, and that is coming. The Fed is saying so themselves.
So I have to ask, if we're talking about bull markets at some point, everyone's still talking about a recession. Can you talk a little bit about where you think we are when it comes to the recession conversation?
Yes. So for those watching at home, we have an enormous amount of slides that we go through, some of which we want to talk about, some of which we don't, because they're just very complicated. We want to educate you, and we want to talk about complicated things in an easy to understand way. So, we're going to jump around here and talk about certain things. So here's a visual. This is a chart of what the entity that officially labels a period of time a recession looks at. Does that make sense?
Yes.
So the National Bureau of Economic Researchers, the NBER, is tasked with the job of labeling a period of time a recession.
And
So
it's after the fact.
it's after the fact because it's using backward-looking data, right?
Yeah.
You have to find a starting point, you have to find an ending point, and then you have to really justify point to point being a recession. So what they've done is they've created this extensive spreadsheet, in essence, a checklist of things that they have to see drop below a certain level for a certain period of time, so they can officially deem a period of time a recession. So we tried to illustrate this to you in a chart. And what you see here, it's color coded, is there is this singular red unbroken line between February, March of 2020, the beginning of the pandemic. The world was shut down, the economy was shut down, and the end of April of 2020. It was the shortest recession in history. They deemed that period of time a recession, right?
Correct.
Because you had real personal income drop dramatically, right? Everyone was unemployed, which finds its way into payroll employment.
Yeah.
Unemployment skyrocketed. Household survey unemployment skyrocketed. Real consumer spending went away. Where could you go to spend money except for like Amazon?
And I circled that green area. I apologize because I got ahead showing the robust recovery coming out of the recession.
Exactly.
Yeah.
So real wholesale retail sales plummeted, in to levels that had never been seen before because the economy's never been shut down before, and industrial production was shut down completely. So then the world started to reopen. But when you're coming off of such an extreme level where, everyone was unemployed, no one was consuming anything, no one was going anywhere, nothing was happening. If you just have any incremental change, you have a whole bunch of green. And we've had a tremendous amount of green since then because it was such an extremely negative period, right?
Yeah.
So now fast forward to all the way to the right of that chart, and let's look at 2022. And if you could just wave your wand around 2022.
Okay. Yep.
There is the data measured month over month over month over month, and this is through August, actually through September. And you can see that there's some red there. There's red in real personal income for a few months. There's red in real consumer spending for a few months. There's a little red in real wholesale and retail sales. There's no red in industrial production. So really what we're trying to say here is the group that nominates a period of time or deems a period of time a recession, they just don't have that red straight line across the board yet. They had some of it here, some of it there, none of it here, none of it there. We think over the next 6 months, they will likely be able to put together, maybe on a diagonal line. Yes, we had a short recessionary period in income. We had a short recessionary period in unemployment. Again, they won't actually deem a recession until we have a significant move in unemployment. There was a short period of time where consumer spending dropped. And then there was a short period of time where industrial production dropped. They're probably not going to have it at the same time. They might be able to take, this month with this quarter with this month and draw that line.
Right.
They may or may not, which is why the recession call is kind of 50-50, right?
Most of the color on here is yellow.
Most of the color is yellow, yes. Some of the red. Some of the green has turned yellow. Some of the red has turned yellow, moving in the other direction. So it's going to be a very challenging task here to call a recession. because you usually have all of this stuff lining up at the same time, and in this case, and potentially over the next 2 quarters, we may not have that lining up.
Yeah.
And I think that is where the Fed comes up with their, we're trying to thread the needle, and we're trying to come in for a soft landing where we don't go into a recession, we just kind of flatline and start to move up. And here's the backup for it, in case everybody was wondering what they're talking about. This is what they're talking about. So hopefully this is helpful to everybody. We look at this stuff all the time.
Yeah.
But this
and I think this is an important point, because you can clearly see the recession of the pandemic. We don't have it on this slide, but if you looked further back at the recession of 2008, it was also a straight red up and down, right? So if we do go into a recession, this is going to look and feel very different than the past two.
There's something that every recession has had in common. There are straight red lines for every single recession in history. That's what makes this slowdown so hard to call, right? Yeah. We could piece together over different periods of time, very likely a light recession, but it's not aligning the way it normally does. So whether they call it a recession or not, I'm certain that the change from where we were in the economy, I'm not talking about the market, this is the economy, a year ago to today, it's certainly slower. But is it really a recession? Have you been to an airport? Have you seen how many people are flying? Have you been on I-95 either during the week or on the weekend and seeing how much traffic is there? People are spending a lot of money, which is why we have inflation, right? If people weren't spending money, inflation would go away pretty quickly. So that's just something to be very mindful of.
Okay, that's great. Thank you for
that. And I also want to be very clear here. When we talk about the economy, we're talking about housing, employment, consumption. It's always referring to backward-looking data.
Yeah.
That is completely separate from the stock market, a bear market, a bull market. This is the market, right?
Yeah.
The stock market will rally before a recession is called. Because the stock market is live and forward-looking.
Exactly.
And it prices in things usually too much to the upside and way too much to the downside, and then quickly reprices based on the data that comes in. So the stock market will start rallying way ahead of a recession being called or the data being finalized, right? The stock market doesn't wait for that. No. So if you go back to 2020, the market bottomed on March 23rd of 2020. The recession was called in July of 2020. Looking back at the market had already rallied.
Correct.
It was by about 22%.
Right.
And people were like, oh my God, they just said recession. Why is the market rallying? Because that's what it always does.
Yeah.
It prices in things way ahead of the official, economic recession or the nominating committee calling it something.
Right. And I think that that's a great example of why, as investors, you shouldn't make these emotional decisions of getting, quote, in and out of the market. That's the danger that you have.
Oh, absolutely. And now more than ever, you actually have yield, right? Whether it be stock dividends, which if you just look at the S&P 500 companies, they on average this year, so far, year's not over yet, they have on average grown their dividend by about 11%. So they've increased their dividend payout by 11%. That's huge.
Yes.
That is above the long-term average. So, are companies really in tough shape here if they're using their cash to increase their dividends? I can tell you in tough times, in real tough times, companies don't increase their dividend. More importantly, they cut their dividend or they suspend it. This is not one of those times, number one. Number two, if you invest in a combination of stocks and bonds, the amount of yield you're getting to stay invested, this time last year was less than 1%. Fast forward to this year, it's annualized at 5%.
Right.
It's amazing to actually say that.
Mhm.
But you look at corporate bonds, you can go on to any financial firm's website and look for corporate bonds. Corporate bonds are yielding about 8%. That's investment grade corporate bonds.
Right.
High yield bonds are yielding about 11%.
And what about municipal bonds?
Municipal bonds, oh my, municipal bonds are actually yielding 5%. Which if you are a high taxpayer, you're in the highest marginal bracket, your taxable equivalent yield is about 10%. Municipal bonds, which are oftentimes backed by government bonds,
Yeah.
are generally speaking very highly rated.
Yeah.
And you can get just about 5% tax free, which is the equivalent of making about 10%. It's been,
I can't remember the last time we could say that.
16, 17, 18 years since I've actually said that. I'm excited about that because there's such a unique opportunity that is not talked about on TV, that is not really talked about in the news, because most people don't understand bonds. But there's a huge opportunity. So that's why I say the bull market in bonds has arrived first. The bull market in stocks is coming very, very soon. And there's not going to be a alarm that goes off. It's very likely this market is in the process of bottoming or has already bottomed. We're so close. And then it's just going to go like this.
Okay.
Once the Fed, pivots, makes a move, so on and so forth, you will just have these very sharp movements up.
Okay.
So the next 12 months, 24 months plus looks actually very good. Easy to say when you're in a hole, right? When the stock market's down, the NASDAQ is down over 30%, small caps are down almost 30%, foreign stocks are down about 30%. Large cap US stocks are down about 25% or so. Gold is down 10%. All asset classes are down. Bonds are down somewhere between 20 and 34, depending on the bonds you look at.
Nowhere to hide.
The future looks as bright as it can look.
Okay.
For investors. So now that you're getting rewarded and paid to sit in your investments, it makes a lot of sense to sit there, especially if you're working with us, you're doing high quality stuff, you don't own garbage. You will be rewarded very well, very, very, very shortly. So can we just talk about before we end earnings?
Okay.
So last week, Apple and Amazon reported, it was, I think, Thursday night. I was laughing because the market was reacting to the language that was used on TV. And some of the language was, this company missed. I'm not making a recommendation to buy or sell securities, but the reporting from CNBC and a few others was that Amazon missed their earnings. Right? They didn't. They actually beat their earnings. But because someone said miss, it triggered a lot of overnight selling. And our clients and us individually, we don't trade overnight. Those are derivative traders. Those are futures traders, right? Those are quant programs. So, the market overreacted. Apple was down. They beat earnings. And then you tune in the next morning, Amazon wasn't down nearly as much as it was overnight. And Apple was way up for the day because, normal investors were like, oh, this was actually a good report. What happened overnight? Crazy things can happen. Don't react to it, right?
And we saw crazy reaction with inflation earlier this year. The same thing.
Oh, absolutely. Yeah. Inflation's coming down. It's not going up. It's coming down. So just be patient. All of this will wash itself out pretty soon. But what you're looking at here is we did this sector by sector. So far, about 60%, 70% of the S&P earnings have come in for the quarter. And it's hard to see, but the middle line there is really the S&P. Each other line is the sector that makes up the S&P 500. And
this is the S&P. Yep.
That's the S&P. So far, shockingly, earnings have come in, 71% of them above expectation, which happens to be the long-term average. And, 4% came in line. So in line or above 3/4 of the S&P 500 companies so far, and only 25% have come in below. And really, if you measure the below, it's slightly below.
Okay.
So earnings continue to net increase and look actually pretty good.
Right.
Are the earnings bad, or are expectations just too high? So if expectations are earnings should be, to the moon, then expectations are too high.
Exactly.
But earnings keep coming in better and better and better and better and better. And that'll probably go sideways for a little while. But at the end of the day, dividend increases, companies buying back their stock, what they're doing is very shareholder friendly like activity. And if things are very bad, I can assure you they will stop being shareholder friendly, hoard their money, pack it in for a terrible environment, and they are doing anything but. And just to prove that to you, we have a buyback slide. So companies have announced in the S&P 500 about a total of $1 trillion of buybacks, the most amount of money ever in history, where companies are going to use their cash to buy back their own stock, right? They can only do it during certain periods, right? It's typically after earnings, the reporting quarter, fiscal year end, so on and so forth. Well, wouldn't you know that the window for companies to buy back their own shares opens wide for all of them, starting, if you look at it, the end of next week.
Okay.
Right. So there's a massive amount of money that has to be purchased back by companies of their own stock because they've made these commitments to do it. And if you don't follow through with it, you will have things like activist shareholders saying, hey, wait a second, you have all this cash. We want you to buy back some shares. We want you to increase your dividends, so on and so forth. And companies don't want to take on corporate raiders, activist shareholders, so on and so forth. So they are going to fulfill their commitment and buy back their shares. Many of them, because this market has been so volatile, have been pushing their buybacks, later into the year. We'll do it later in the year. We'll do it later in the year. Well, later in the year is here. And now they need to actually fulfill that commitment. So in a weird way, when you hear things like the fourth quarter of the year is always the best quarter of the year, or there's a Santa Claus rally, or, November and December tend to be pretty good, I can assure you this is one of the reasons why, because a lot of these buybacks get executed towards the end of the year. So if there's any more negative data, negative forces pushing the market down, holding the market down, some of the offset here is going to be the incredible positive force of companies buying back their own shares, especially when you consider how much money is going to be allocated into buybacks. So I figured I would end on that note. We're going to talk about that more and some other interesting topics in future videos. But I think that is one that really needs to be understood by investors.
No, I think that that's important. And, despite what we're seeing from the Fed and the concerns and this discussion around a recession, there is so much that is supportive of not only the stock market going forward, whether it's the buybacks, the earnings, even just coming off the lows that we are, but there's also a lot of support for the bond market as well. So that's what I'm hearing.
Yes, it's gone from it couldn't be less attractive to the bond market probably couldn't be more attractive, or as attractive as it's been in the past 20 years. You're actually getting a reward now for owning bonds, probably starting last quarter through potentially a very long period of time.
Okay, that's great. Thank you. And we certainly realize that as investors, it's a challenging time right now to look at our statements. So I always say we're here for you. If you have any questions, please reach out to us.
Yeah. And just, our clients own high quality investments, whether they're outright through mutual funds, through exchange traded funds, so on and so forth. When you look at the underlying holdings, it's mostly mega cap US, dividend paying, dividend growing, high cash value, high cash balance, high free cash flow securities. Most of our investors, if we told them what their top 20 underlying holdings are, they would know every company well. They use the brands, they live off of the brands, so on and so forth. So hang in there. Things are down in value, but it doesn't mean the securities are low quality. They're actually quite high quality investments that everybody at this firm owns. So
Okay, that's great.
we'll be through it shortly. We'll probably come back to you. We didn't really mention the midterm elections. We'll probably come back to you after the midterms. Certainly expect to hear from us if there's any bad news. We just thought this Fed meeting, it's making headlines. We would address it. So here we are.
That's great. So as Bob always, thank you for your insight.
Yeah, and thank you, Julina. Hopefully the viewers find this helpful.